Right then, let's have a proper chat about workplace pensions because honestly, this is one of those things that can genuinely make a massive difference to your future, but loads of people just ignore it or don't really understand it properly. So first things first, what exactly is a workplace pension? Well, it's basically a savings pot that you and your employer both contribute to, and the money sits there growing over time until you reach retirement age. It's designed to give you an income when you stop working. The clever bit is that both you and your employer get tax relief on your contributions, which means you're essentially getting free money from the government. Now, let's talk about contributions because this is where you can really maximize your pension. In the current tax year, if you're paying into a personal pension or your workplace scheme, you can get tax relief on up to £100,000 worth of contributions. That's quite generous actually. For most people though, you'll be paying in a percentage of your salary, typically somewhere between 4 and 10% depending on your scheme. Here's something really important that people miss. If you contribute money to your pension, the government tops it up with tax relief. So if you're a basic rate taxpayer and you put in £80, the government adds £20. If you're a higher rate taxpayer, you can claim back even more through your self-assessment tax return. This is literally free money, so not taking advantage of it is just leaving cash on the table. Let me give you a concrete example. Say you earn £40,000 a year and you contribute 5% to your workplace pension. That's £2,000 a year that comes straight out of your salary before tax. Now, as a basic rate taxpayer, the government automatically tops that up to £2,500 through tax relief. So you've only paid £2,000 out of your pocket, but your pension pot has grown by £2,500. That's incredibly valuable. The thing about workplace pensions is they're usually pretty good value compared to personal pensions because your employer is legally required to contribute too. In fact, since October 2022, employers have to contribute at least 3% if you contribute at least 5%. So if you're hitting that 5% threshold, your employer is popping in 3% automatically. That's basically 8% of your salary going into your pension pot without you having to do anything. Some employers are more generous and contribute more, so definitely check what yours is doing. Now, one mistake I see people make all the time is just setting their contribution at the minimum and forgetting about it. Yes, if you contribute 5% and get 3% from your employer, that's decent. But if you can stretch to contribute a bit more, you can absolutely supercharge your retirement savings. The difference between contributing 5% and contributing 10% over 30 or 40 years is absolutely enormous due to compound growth. Let me break down the power of that. If you start at age 25 with a salary of £30,000 and contribute 10% every year with an average investment return of 5%, by age 65 you'd have accumulated a significant pot. Now if you'd only contributed 5%, you'd have roughly half that amount. Time is your biggest advantage here, so the earlier you start and the more you contribute, the better off you'll be. Here's another crucial thing about using your pension effectively. You need to understand where your money is invested. Your pension money doesn't just sit in a bank account earning nothing. It's invested in things like stocks and bonds. Most workplace schemes offer you a choice of funds. Some people just stick with the default option without thinking about it, but you should look at the options available. If you're young, you can typically afford to take more risk because you've got time to recover from any market downturns. So you might want a higher proportion in shares. As you get closer to retirement, you might want to move to something more cautious with less volatility. It's worth having a look at the funds available in your scheme and making sure your money is in something that matches your situation. Another thing to consider is whether you can make additional voluntary contributions or AVCs. Some schemes allow this. If you've had a year where you've earned more money or come into some cash, putting extra into your pension is a brilliant use of your money from a tax perspective. You get full tax relief on those contributions too. Now let's talk about the actual rules around accessing your pension because this catches people out. You can't usually access your workplace pension until you reach your pension age, which for most people is now 68. There are some exceptions, so if you have genuine financial hardship, you might be able to access it earlier, but these are rare and your scheme would have to agree. The great news is that most schemes allow you to take a quarter of your pension pot tax-free when you reach your pension age. The rest you can either take as a lump sum and pay tax on it, or you can keep it invested and draw an income from it, or you can buy an annuity which guarantees you an income for life. The flexibility is actually really good these days, so you've got options. One thing to be really aware of is pension scams. There are criminals out there who contact people offering to unlock their pension early or move their pension to some dodgy offshore scheme. Don't fall for it. If someone contacts you offering this kind of thing, they're almost certainly trying to rob you. Your pension is protected and you shouldn't be accessing it early. If you need money urgently, there are better ways to sort it out. So let me summarize how to use your workplace pension effectively. First, contribute at least enough to get your employer's full contribution. If they'll match 3%, you contribute at least 5%. Second, consider contributing more if you can, especially when you're young. Every extra pound going in compounds over decades. Third, look at how your money is invested and make sure it matches your attitude to risk and how long until retirement. Fourth, if you get a pay rise, consider putting some of that extra money into your pension instead of spending it all. Fifth, understand the tax relief you're getting and make sure you're claiming all of it, especially if you're a higher rate taxpayer. Finally, review your pension every couple of years. Check how much you've got, how it's growing, and whether you're on track for the retirement you want. Some people find that scary, but it's much better to know where you stand and make adjustments now than to wake up at 65 with no idea what you've got. Your workplace pension is genuinely one of the best tools for building long-term wealth in this country. The combination of your contributions, your employer's contributions, and tax relief from the government means you're getting free money. Not taking advantage of it is honestly a missed opportunity. Right, so if you found this helpful, please do smash that like button because it helps the channel out massively. Subscribe if you haven't already so you don't miss future videos about personal finance that actually matter. And drop a comment below letting me know if there's anything else about pensions you'd like me to cover. Cheers for watching.